Well, the numbers are in and the cost of living adjustment for Social Security has been released, but it might not be all that it seems after you pay some additional expenses that also increased. And stay tuned till the end. Jay and I have a few tips that you'll want to take care of before the end of the 2025 tax year.
Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And we're sitting here, it's early November, and as we're counting down the days just towards Thanksgiving, Christmas, and New Year's, you might be also sitting there counting down the days until you get your Social Security COLA increase, which, depending on the year, could be really, really good, or it could just be more on the average side. One thing that you might not be expecting is if you're paying Medicare premiums, those are expected to go up as well. And that's kind of a nasty shock, especially if you're on Social Security for the first time and don't realize that those premiums go up too.
Yeah, so let's take the first piece of that, Jay. The cost of living adjustment, that's an adjustment that recipients of Social Security get, and it changes each year, like you alluded to. This year, it's going to be 2.8%. That's the official number. It's supposed to be indexed for inflation, right? So,
Yeah.
if you remember back a couple years ago, and I think it was 2022 is when the COLA actually hit, or maybe it was 23, but they had like a 9% COLA because inflation was really high back then, if you remember. And so I know people getting Social Security benefits were really happy about that, but also that means there's a lot of inflation. So
Yeah.
2.8%, that's roughly where the inflation rate is, at least that they say it is. So what that means, for the average person, the average benefit's about $2,000. So in 2026, that average benefit's going to go up by $56. 2056. The part that, and that's great. I think people who are on Social Security, to get that cost of living adjustment, it of course helps a little bit. The flip side of that, and the part that people are not expecting, and the reason why I mentioned in the intro why it might not be all that it seems, is because Medicare premiums, which I would say most Social Security recipients are also on Medicare, the Part B premiums are projected to rise 11.6%. So you get 2.8% cost of living adjustment, and then there's potentially an 11.6% Medicare adjustment. So you're not going to feel that full cost of living increase like you might have.
Yeah, those Part B premiums, the average monthly premium for that is about $185.
Right.
And if it's 11.5 or 11.6%, if it's increasing by that amount, then those premiums would then jump to about $206, $207 a month. And so, yeah, that definitely eats into that COLA adjustment for Social Security.
Well, and that's one of the reasons, Jay, I know when we do financial planning with clients, when you build a financial plan, you have inflation factors built in, and you have inflation factors growing at different rates. And as we know, and as we plan for, healthcare inflation goes up a lot quicker than just your normal inflation. And I think this is first and foremost, what you're seeing. One of the reasons why you need to build, when you're building a financial plan, you're going into retirement and working with your advisors, you need to build that in, because that's one thing that you can count on is, yes, Social Security will go up a little bit each year, but all the other expenses go up as well. Just, the cost of living goes up, but then also the cost of healthcare and all these other things, continue to go up. The only thing that doesn't go up is, fixed rate loans, but
yeah. I think the other thing too is, so we might have talked about this in previous videos, but with Medicare, whatever you pay for, Part B or Part D, that's all based off of what your total income was from a prior tax year.
Right.
And for a married couple, if your income is at a certain point, then they impose what's called IRMA, or income. I'm trying to remember what the exact term is, but it's essentially an income Medicare adjustment. So, let's say your premiums were $180 or $185 a month. Well, if your income was X amount, like more, then those premiums would be $250 a month or $300 a month.
Yeah.
So those surcharges are going up as well. Not to the extent of what just the premiums are, but I believe Part B is raising by 1%. But Part D, which is for drugs and prescriptions, those surcharges are raising, I believe, up to 6%.
Yeah. The income related Medicare adjustment amounts, I think, is what that stands for. But
Yeah.
yeah, I mean, and that's the tricky part of planning, right? Because you can do a lot of planning in retirement and maybe doing some things that we're going to talk about here at the end of the video. But that IRMA adjustment kind of can catch you off guard because they look back, what is it, 2 years,
Yeah.
and if you kind of catch yourself earning too much money in one of those years, you can get that IRMA. And there are ways to petition that, but you have to have a pretty good reason to get that reversed. But ultimately, yeah, it just looks like these healthcare expenses are going up across the board. I think we've seen that here in the whole the government shutdown debate. Healthcare and all of the premiums and subsidies that the government gives for these exchanges. That's been a huge component of it. So obviously healthcare across the board has really gone up, and I think that's definitely going to hit the pocketbook, on the bottom line.
Yeah. So, with all that being said, I know Dustin mentioned it earlier in the video, but we just wanted to give a quick year-end checklist for things maybe that you either haven't done yet, or you're thinking about ways either to save taxes, or save on taxes, or just things to do to help lower your income overall. But the big one that we've been getting a lot of questions on are qualified charitable distributions. And these would be from your IRA. And essentially, when you're at the age where you have to take an RMD, rather than just taking that as cash, pay taxes on that, and go forward, you can actually elect to have the RMD distributed to a qualified charity. And so what happens is, let's say the RMD was 20,000, that charity would get the money, so you don't get it at all. It's tax free to you in the sense that we don't pay any income taxes on that.
You just get to basically have it count towards your RMD, and you get to take it tax free, which is huge because all that money is ordinary income. And so if you can, satisfy your RMD and donate to a charity, not pay the tax, that's a big component. Now, the kicker is you have to be 70 and a half.
Yeah.
I don't know where they came up with that. I think that 70 and a half is coming from the old RMD age, but whatever. 70 and a half or older, you can qualify for the QCDs, but so that's the one thing there. And everybody who's asked me about that, or we've been talking about that, unfortunately, they were all below 70 and a half, so it's not going to work for them.
Yeah.
So that's one. The next one is Roth conversions. We've done videos on Roth conversions. I'm sure we'll do more. But as we get into, we're in the last month and a half of the year, you've gotten most of your income in. Now is the time, if you want to have a Roth conversion count for 2025 income. Again, you're converting pre-tax money to tax-free, paying the tax now, hopefully, and that's the whole reason for planning, is it should be at a lower rate than in the future. So get those in before the end of the year. Mm-hmm. Maybe you can talk about the bunching of deductions, Jay.
Yeah. So what a lot of people will do if they want to bunch their itemized deductions, just to have, let's say they're in a year where the income's a bit higher than normal and they want to have more deductions or write-offs just to help offset that. Though there's a couple ways they can do that, but they can prepay their 2026 property taxes in the current year. So all that would be counted towards your 25 itemizing. If you have medical expenses that you've been paying on over the year and you have the funds to pay more down, then you can pay more of those, just to get a bigger medical expense deduction. Or even with charity. Now, a lot of people tend to do their charitable giving either one of two ways. They'll either do it monthly through just church or tithing, or I've seen a lot where they'll kind of wait till the end of the year and then just do all their charitable giving just to their various organizations. So one thing might be is to just double it. So instead of giving donations for this year and for next year, you can plan on giving both of them now if you have the funds, and then your write-offs would be bigger for this year. So there's that.
Just make sure you check with Jay first, because you have to itemize to take advantage.
You have to itemize, and there's some other income limitations too.
Yeah.
But yeah, so you have that. You also have tax loss harvesting. So if you have a brokerage account or an after-tax account and you have investments, let's say you want to recognize a gain, or you have recognized a capital gain, and you want to help offset that gain. If you have any investments that have losses in the portfolio, you can sell those and claim that loss to offset any current capital gains for the year. And let's say you don't have any capital gains, you're just wanting to take these losses and move forward. Well, you can write off up to $3,000 in capital losses each year. So if you had a loss of, let's say, $9,000, you can take up to $3,000 against just other ordinary income, and then that $6,000 gets carried over to the next year. And if it's the same situation, you take $3,000 that year, and then it's carried over to the third year.
Let's hope there's no losses this year.
No, exactly.
So another one is max out your HSA. If you haven't already, if you have that available to you. If you remember HSAs, you get triple tax-free treatment there.
Mm-hmm.
Another one is mega backdoor Roth. I won't go into it super. Maybe we need to make a whole nother video on that, because there's some there's some things you got to follow for all that. But if you're familiar with it, get those contributions made and converted over to Roth in your 401k. And then, the last one is just whatever you're doing here, just make sure, if you are to the age where some of these income limitations could affect, IRMA and those things, or if you're a couple years before 65, so if you're like 63 and up, make sure any of this planning that you're doing is at least not going to affect your IRMA, or at least about it, going into it. You don't make an and then figure it out later. But all these things, as we get into this, let's just say kind of final stretch of the year, if you can get it all in before 12/31, potentially could help you on taxes and set you up from a good tax perspective, and then also just set you up right for 2026.
You got it.
All right. Well, we hope that you enjoyed today's video. If you did, please like, subscribe. If you have any questions about what we covered, feel free to reach out to us. Take care. We'll see you in the next video.
Bye.